The term high-yield investments refers to financial instruments that are issued by highly leveraged or small-scale businesses. These investments offer great returns to investors, but they also carry a large amount of credit risk. In exchange for a higher level of risk, the issuer offers a rate of interest that is more alluring when compared to safer investment-grade bonds. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about the top 10 high-yield investments to grow your money. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Number 10. Treasury bills, T-bills. Treasury bills are a type of short-term financial obligation that is issued by the United States Treasury. Due to the fact that they are guaranteed by the United States Treasury, these are assets that carry a very low level of risk. When you purchase a T-bill, the government makes the commitment to repay your debt along with a predetermined interest rate. These loans can have terms ranging from 4 weeks to an entire year, at the borrower's discretion. The benefits include a fixed interest rate that is guaranteed, backed by the unwavering confidence of the United States government, a low initial investment requirement, short maturity durations, and exemption from state and local taxes. Treasury bill interest rates are often quite low, and they are also susceptible to some degree of interest rate risk and inflation risk. Number 9. High-yield savings accounts. Even though high-yield savings accounts aren't technically investments, they are among the most reliable ways to build your financial cushion. When compared to a regular savings account, they do in fact offer a higher APY, which stands for annual percentage yield. They bring about a greater return as a consequence of this. The advantages include having full liquidity, a very low initial investment, and frequent FDIC guarantees. Because of the fundamental risk associated with these accounts, which is simply that they are unlikely to increase in line with inflation, they are typically best suited for investments that have a shorter time horizon and are of lesser monetary value. Long-term investment goals should be avoided in favor of these accounts. At many different institutions, you can get started with a high-yield savings account. At the moment, the typical interest rate offered by high-yield savings accounts is somewhere around 4.4%. Number 8. Certificates of deposit. Certificates of deposit are a specific sort of savings product that enables investors to put their money away for a predetermined amount of time while also earning interest on the principal amount. The money that is kept in one of these accounts is kept there for a predetermined amount of time, also known as the term length. The term length can range anywhere from a few months to 10 years. The benefits include being guaranteed by the FDIC, guaranteeing a return, and returning money within a predetermined window of time. The value of the money in these accounts may be jeopardized if inflation rates continue to rise. Number 7. I bonds. In periods of high inflation, Series I bonds are among the most reliable investments. The purpose of these savings bonds, which the U.S. government issues, is to help investors guard their money's purchasing power against the effects of inflation. Investors in I bonds get interest payments during the course of the bond's entire 30-year maturity. In addition, they receive a biannual inflation rate that is adjusted to reflect changes in the rate of overall economic inflation. Number 6. Money market funds. Money market mutual funds are mutual funds that invest in high-quality debt securities with short maturities. Because all investments made by a money market fund must meet particular liquidity and asset quality criteria, they ensure a minimal level of volatility. Money market funds are usually seen as a great place to temporarily store money due to their low degree of risk. However, because they do not appreciate in value and are not expected to generate big returns, they are often seen as investments with a longer time horizon. Number 5. Municipal bonds. State, local, and other non-federal governments can issue municipal bonds as a type of debt instrument. Their principal goal is to generate cash to fund public works projects such as roads and school buildings. They are similar to government bonds, except that they are issued by state and local governments rather than the federal government of the United States. Depending on the type of bond purchased, these could be considered short-term or long-term investments. Municipal bonds pay interest at regular intervals, usually twice a year. Because they are usually backed by local governments, these bonds have a very low default risk. However, because they are fixed income products, their value might fall when interest rates rise, especially in the case of bonds with longer maturities. Number 4. Corporate bonds. As opposed to government bonds, corporate bonds are considered debt obligations. When compared to government investments, these often offer slightly higher returns with lower levels of related risk. Corporate bond interest rates are always the same. This means that whenever the Federal Reserve decides to raise interest rates, the value of corporate bonds will fall, resulting in an overall increase in interest rates. Furthermore, the bonds are not insured by the FDIC, which adds another layer of risk. Because the bonds are solely backed by the company's earnings and assets, investors must conduct extensive research to ensure that they understand the risks associated with investing in specific corporate bonds in the event that the company runs into financial difficulties or declares bankruptcy. Number 3. Dividend stock funds. Dividend stock funds are mutual funds and exchange-traded funds, ETFs, that pay dividends. Dividend stock funds allow you to diversify your assets while also capitalizing on corporate profits. If a company is unable to make profits, it is probable that you will no longer be rewarded. These rewards are also not guaranteed in any way. Most importantly, because the underlying investments are dividend-paying corporations, these investments are not immune to big losses when the overall stock market falls. Number 2. ETFs. A type of mutual fund called an exchange-traded fund, ETF, pools the money contributed by a number of members and invests it in a variety of assets. These securities generally track a single industry or product area. When compared to purchasing individual stocks, investing in exchange-traded funds, ETFs, might be regarded as a lower-risk option because ETF come with built-in diversification. This means that your money will not be invested solely in the stock of one company. Furthermore, if an ETF is managed by a broker, the broker fees associated with the ETF may be lower than those associated with individual investments. Although the yields and risks associated with an ETF may be smaller than those associated with individual shares, investors are still susceptible to market movements. Number 1. REITs. A real estate investment trust, or REIT for short, is one type of real estate investment. If you invest in REITs, you won't have to worry about the day-to-day operations of a property. Instead, you make an investment in a company that owns real estate, which allows you to get income without requiring a large time commitment. Throughout financial history, real estate has typically been seen as a dependable investment that has contributed to portfolio diversification. When compared to some of the other investment alternatives discussed in this article, REITs, also known as real estate investment trusts, have a slightly higher level of risk. This is because they often necessitate a larger initial investment. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.